So we are now a little over a week after the Federal Reserve decided to cut rates a quarter of a point or 25 basis points. And President Trump has expressed his displeasure for that. And many financial professionals, especially mainstream regular financial professionals, people who are not Austrian School of Economics, people who are not libertarian, who are not limited government, are criticizing the Fed for why they would cut rates during a supposed continued economic expansion. We're over 120 months into this supposedly booming, great quote unquote greatest economy ever. And I want to talk about the real reasons why this is doing so, why the Treasury Department wants this, why President Trump wants this, and why the Federal Reserve is being pressured into doing this. It doesn't seem like everyone at the Fed is on board with this, but this might be one of the few things that Jerome Powell and President Trump actually agree on. Now, pretty much all these countries, all the main countries, whether it's China, the US, the European Union, Japan, they all want to try to do a controlled devaluation of their currency. So President Trump was on Twitter again today, and he's been tweeting, he's always tweeting, but these particular tweets, though, were about, of course, the dollar. So the dollar index right now, when we're doing this live stream show, is under 98. The dollar index has failed to hold 98 again. It's a 97.56. And the trade-weighted dollar, Raoul Pal, the former hedge fund manager and co-founder of Real Vision, he was saying how it was very close to an all-time breakout. So the Fed, remember I said the Fed watches both. I'm sure the Treasury does too. So the trade-weighted dollar monitors more of the emerging market currencies. So President Trump has been tweeting, let me pull up the tweets real quick. Zero Hedge summarized this. The quote from Zero Hedge, and this is not the whole tweet, is, as your president, one would think that I would be thrilled with our very strong dollar. I am not, end quote. So that's a partial summarization of the tweet. I'll pull up the full tweet here. Let me get it. Okay, here we go. So this is from 7 hours ago. As your president, one would think that I would be thrilled with our very strong dollar. I am not. The Fed's high interest rate level in comparison to other countries is keeping the dollar high, making it more difficult for our great manufacturers like Caterpillar, Boeing, John Deere, our car companies, and others to compete on a level playing field. With substantial Fed cuts, there is, in parenthesis now, there is no inflation. Remember in his prior tweets, years before he got elected, he was talking about there was inflation. I guess things change once you're in power. And no quantitative tightening. The dollar will make it possible for our companies to win against any competition. We have the greatest companies in the world. This is another tweet. So we're on 3 tweets now. We have the greatest companies in the world. There is nobody even close. But unfortunately, the same cannot be said about our Federal Reserve. They have called it wrong at every step of the way, and we are still winning. Can you imagine what would happen if they actually called it right? So President Trump, there's been a lot of tweets lately. If I went and counted them up, I would say there's been like over 8 just in the last couple weeks alone, talking about how the dollar is too strong, how he wants a weaker dollar. He does not want a strong dollar. They want a controlled devaluation. They don't want the dollar to crash. They believe the hubris of these people in power at Treasury departments, central bankers, is that they can control a devaluation. So at one point, all the governments were coordinating during and after the 2008 financial crisis. So you had the European Union, the Japanese government, and Bank of Japan, Bank of England, English government. You had the US and the Federal Reserve, the Treasury, all working with each other. But then there would be times where they would take turns with coordinated devaluations and quantitative easing, where one currency would go up, another one would go down, and this went on for a while. But it was predictable that this would not last, because we knew that there wasn't a real recovery. We knew that more debt was being created to deal with a global debt problem in all these major economies. And so we knew eventually that these countries, it would be, I think I accidentally said companies, I meant countries, eventually it would be every man or woman or country for themselves. And if you're a student of financial history, this goes back to the beggar thy neighbor policies. And I talked about this a couple weeks ago about the European Central Bank wanting to do this with rate cuts, negative interest rates, deeper negative interest rates, more quantitative easing, more interest rate cuts. And herein lies the real reason why President Trump And this is why most financial professionals don't understand this, because I brought it up to them and they don't want to hear any of this. And we're going back to currency wars. So Jim Rickards wrote this great book. If you have not already read Currency Wars, it first came out in 2011. It has been reprinted in paperback, I think, in 2012. And if you want to read the actual book, it's pretty cheap now on Amazon, like a used copy of it, or you can get it on Audible audiobook. So if you have not read it already, I highly recommend doing so, or rereading it maybe again. Actually, Jim Rickards has a new book out called Aftermath. I just bought it. I have not read it yet, but I just saw a new interview with Jim Rickards and Keith McCulloch from Hedgeye, and they spent a good amount of the time in the interview, rather than necessarily talking about the new book, they were talking about the currency war that's restarting. So in my humble opinion, the U.S. is trying to get, because the real global economy, not this all these fake government economic data and fake GDP and saying how there's no inflation, but the real economy with a real inflation rate, the real economic data that we know is getting worse in the global economy and in the US and China and elsewhere, and in Europe especially. We know it's getting bad. South Korea with exports, we know and Taiwan, we know this data is not good. Anyone who's paying attention can see this. And so this is a situation where you have all these governments fighting to either maintain the size of their, it's like think of the global economy as a pizza, and these governments are all fighting to either maintain or grow their share of the pizza. The problem now is the size of the pizza isn't growing, and you have these governments, especially the largest governments like the US, the European Union, China, Japan, all fighting to maintain or grow their share of the pizza, their slice of the pizza. So the pizza is shrinking in real terms due to inflation, taxes, the global economy slowing down, misallocations of capital. It's stagnating and contracting in reality with a real inflation rate and all the rules, regulations, taxes, tariffs, all these things that are happening. Trade war escalating with the U.S. and European Union, the U.S. and China, the tariffs back and forth. Whoop, accidentally hit the mic there. And this is why you're getting back into the currency wars. So Jim Rickards wrote if you don't want to read the whole book, Jim Rickards wrote a couple articles again in 2015 summarizing a brief history of currency wars, so I'll read it now. This was in 2015. It's from internationalman.com and on the Daily Reckoning. So if you want to read this article later. Currency wars are one of the most important dynamics in the global financial system today. A currency war is a battle, but it's primarily economic. It's about economic policy. The basic idea is that countries want to cheapen their currency. Now, they say that they want to cheapen their currency to promote exports. Maybe it makes a Boeing more competitive internationally with Airbus. But the real reason, the one that's less talked about, is that countries actually want to import inflation. Take the United States, for example. We have a trade deficit, not a surplus. If the dollar is cheaper, it makes our exports slightly more attractive. It's going to increase the price of the goods we buy, whether it's manufactured good, textiles, electronics, etc. And that inflation then feeds into the supply chain in the U.S. and globally. So currency wars, he didn't add globally, I added that. So currency wars are actually a way of creating monetary ease and importing inflation. The problem is once one country tries to cheapen their currency, another one country cheapens its currency, and so on, causing a race to the bottom. And this started in earnest. Now, Jim Rickards talks about the other historical parts of let me read the historical parts first, and then I'll get into some of the other, my opinion on this. So, of course, I started talking about this a year ago in the first book, Currency Wars. I don't know. It says this was from 2015. I don't know what. They must have reprinted this article and then released it a couple years later. My point then is the same today. The world is not always in a currency war, but when we are, they can last for 5 or 10, 15, or even 20 years. They can last for a very long time. So there have been 3 currency wars in the past 100 years. Currency War 1 covered the period from 1921 to 1936. It really started with the Weimar Republic hyperinflation. There was a period of successive currency devaluation. In 1921, Germany destroyed its currency. In 1925, France, Belgium, and others did the same thing. What was going on at that time prior to World War I in 1914? For a long time before that, the world had been on what's called the classical gold standard. If you had a balance of payments, your deficit, you paid for it in gold. So if you were running a trade deficit, if your trade deficit ballooned too much back then, you had to pay in gold.
a lot of gold left your country, and then your currency was at risk under attack of collapsing and hyperinflation. So governments, gold was the natural regulator of the system. So gold kept things in check back then. If a country was running too large of a trade deficit, they risked losing too much or all of their gold, and then their currency risked becoming, totally unbacked and potentially worth less until it was worthless. Okay, let me continue on. If you had a balance of payments surplus, you acquired gold. Gold was the regulator, or of expansion. I didn't see regulator. I didn't read this article yet. Regulator of expansion or contraction of individual economies. So him and I are thinking on the same page. I think I've heard him talk about this in the past. Maybe that word regulators back there in my long-term memory. You had to be productive, pursue your comparative advantage, and have a good business environment to actually get some gold in the system, or at least avoid losing the gold you had. It was a very stable system that promoted enormous growth and low inflation. That system was torn up in 1914 because countries needed to print money to fight World War I. When World War I was over and the world entered the early 1920s, countries wanted to go back to the gold standard, but they didn't quite know how to do it. There was a conference in Genoa, Italy in 1922 where the problem was discussed. The world started out before World War I with the parity. There was a certain amount of gold and a certain amount of paper money backed by gold. Then the paper money supply was doubled. That left only two choices if countries wanted to go back to a gold standard. They could have doubled the price of gold, basically cut the value of their currency in half, or they could have cut the money supply in half. They could have done either one, but they had to get to the parity either at the new level or the old level. The French said, quote, "This is easy, we're going to cut the value of the currency in half," end quote. They did that. If you saw the Woody Allen movie Midnight in Paris, it shows U.S. expatriates living a very high lifestyle in France in mid-1920s. That was true because of the hyperinflation of France. It wasn't as bad as the Weimar hyperinflation in Germany, but it was pretty bad. If you had a modest amount of dollars, you could go to France and live like a king. The United Kingdom had the same decision to make, but they made it differently than France did. There, instead of doubling the price of gold, they cut their money supply in half. They went back to the pre-World War I parity gold price. There was a decision made by Winston Churchill, who was the Chancellor of the Exchequer at the time. It was extremely deflationary. The point is, when you've doubled the money supply, you might not like it, but you did it, and you have to own up to that and recognize that you've trashed your currency. Churchill felt duty-bound to live up to the old value. He cut the money supply in half, and that threw the UK into a depression 3 years ahead of the rest of the world. While the rest of the world ran into the depression in 1929, the UK, it started in 1926. And Jim Rickards mentions this story because to go back to gold at a much higher price, measured in sterling, would have been the right way to do it, in Jim Rickards' opinion. Choosing the wrong price of gold was a contributor to the United Kingdom's Great Depression and probably fed into the U.S. The Fed, if you read Murray Rothbard's book about the Great Depression, the Federal Reserve also did a bunch of things really, really bad. Besides the credit boom in the 1920s, they also coordinated with the Bank of England, and the United States should have had a lot more gold come in, and they refused to take the gold. So there was a bunch of other mistakes. I mean, the Fed has always made a lot of mistakes, but particularly in the 1920s and leading up to the 29 Depression, the Fed made egregious amounts of mistakes. Okay, let me continue. Economists today say, quote, "We could never have a gold standard. Don't you know that the gold standard caused the Great Depression," end quote. I do know that it was a contributor to... No, the gold standard was not a contributor. I disagree with that with Jim Rickards. He says it was the price of gold that was a contributor to the Great Depression. I disagree with that. A lot of it was the Fed. Go and read. I recommend reading Murray Rothbard's America's Great Depression book. He goes through this exhaustively. He doesn't talk about the currency wars in the 20s, but a lot of the other details Murray Rothbard is super accurate on. There's a lot of other sources cited in his book. You can get that on Audible audiobook too. Churchill picked the wrong price, and that was deflationary. The lesson in the 1920s is not that you can't have a gold standard, but that a country needs to get the price right. Actually, I would prefer that the market sets the price. But I guess a gold standard is better than nothing because it means the currency won't be totally destroyed. But governments are going to figure out a way to cheat on this anyway. If you go back through financial history, whether it's, Romans clipping coins or taking copper coins and dipping them in silver, I mean, there's, fractional reserve banking, the original fractional reserve banking, where the gold was in the vault of a private bank, and then the bank would issue more
receipts, more certificates than they actually had metal for, betting that people wouldn't redeem. So there's always going to be ways to cheat it. Now, if you have the right system in place of checks and balances, there's ways to stop this, but eventually governments they hate gold. They won't voluntarily go back to gold. All governments hate gold. They may buy it for reserves. They may buy it to protect against currency collapse of like the dollar or this system. But I don't see any government really, especially considering how most of these people in the Treasury departments and the central banks and the academics that advise these central banks and the Treasury departments, they've all gotten their education to hate gold. I don't see anyone willing to do that. For every like Judy Shelton who seems to like gold forever. And by the way, Judy Shelton wants rate cuts too. So even though Judy Shelton wants a gold standard, she still wants to inflate like crazy and do currency wars and competitive devaluations of the dollar before going back on a gold standard. So she's not perfect either. And a gold standard is not perfect because, like I said, a lot of governments throughout history have always cheated. They figured out ways to cheat. They overstate their gold reserves. They clip coins. They do fractional reserve gold banking. That was in the private sector, and I guess governments probably would do it too. Okay, let me continue back with the article. The lesson of they continued down that path until finally it was unbearable for the UK, and they devalued in 1931. Soon after the US devalued in 1933, they devalued against gold. I don't think the article mentioned that, so nothing else worked. The Federal FDR's Treasury Secretary, Henry Morgenthau, he wrote a memoirs book, and he admitted that all their New Deal programs and all their government deficit spending and their debt, nothing worked. So they tried all these other things, and eventually they had to do the quote-unquote nuclear option, which there was no other way for the governments to get the inflation they wanted, and they devalued against gold. And I think ultimately we're probably going to end up going back to there, but I think these stupid central bankers and Treasury Department officials and PhD economists, I think they will try literally everything else first, including like really negative interest rates, and that's starting to become popular now among the people at the Federal Reserve banks, whereas a couple years ago it wasn't popular at all. And then even Ben Bernanke's suggestion of zero coupon perpetual bonds to inflate away debt, they may try that first before devaluing against gold. I hope I'm wrong about that, but I think they may do that anyway. Okay, soon after the U.S. devalued in 1933 against gold, wasn't mentioned that it was against gold in this article. I added that. Then France and the United Kingdom devalued again in 1936. Wow, a lot of devaluations. You had a period of successive currency devaluations and so-called, quote, beggar thy neighbor, end quote, policies. Okay, let me deviate a second from this Jim Rickards article. If you don't remember beggar thy neighbor, it's a term for policies that a country enacts to address its economic woes that in turn actually worsens the economic problems of other countries. The term comes from the policy's impact as it makes a beggar out of neighboring countries. This is from Investopedia. So beggar thy neighbor often refers to international trade policy that benefits the country that enacted it while harming its neighbors or trade partners. Beggar thy neighbor policies came about originally as policy solution, in air quotes, to domestic depression and high unemployment rates. The basic idea is to increase the demand for nations' exports while reducing reliance on imports. This means driving consumption of domestic goods up as opposed to consumption of imports. This is usually achieved with some kind of trade barrier, tariffs or quotas, or competitive devaluation, or a combination of the three, in order to lower the price of exports and drive employment and the price of imports up. So back to the Jim Rickards article. The result was, of course, one of the worst depressions in world history. So this is the prolonged 29 depression that lasted for a long time. There was skyrocketing unemployment and crushed industrial production that created a long period of very weak to negative growth. Currency War I was not resolved until World War II, and then finally at the Bretton Woods Conference. And the Bretton Woods Conference is all currencies were pegged to the dollar and the dollar was pegged to gold. And this was assuming that the U.S., remember, American citizens could still not own gold. Because after FDR had devalued the dollar against gold, simultaneously, I believe, he had also tried to confiscate gold from American citizens. Now, not every American citizen turned in their gold. There was a threat of large $10,000 fine. Back then, $10,000 was even more than now. $10,000 is still a lot now, but it was, in purchasing power, worth a lot more back then. And I think 5 years in prison, if I remember the ad correctly in the paper. And some Americans hid their gold, or they went up to Canada and deposited up there to get around it. So the Bretton Woods Agreement was all currencies were pegged to the dollar, and the dollar was pegged to gold. And there was only the U.S. dollar was the only country on an international gold standard back then. And this was assuming the U.S. with this exorbitant privilege of the world reserve currency and an international gold standard would be fiscally responsible, which it was not. And it got worse and worse and worse until President Richard Nixon closed the last vestiges of the international gold standard in 1971. And remember, if you go and look up the speech on YouTube, it was during a popular TV show. He said that, quote unquote, it would only be temporary. And Milton Friedman, I don't agree with Milton Friedman on a lot, but Milton Friedman said there's nothing as permanent as a temporary government program. So that's when the world was put on a new monetary standard. Back to Jim Rickards' article. That's when the world was put on a new monetary standard. Currency War II ranged from 1967 to 1987. According to Jim Rickards, the seminal event in the middle of this war was Nixon's taking the U.S. and ultimately the world off the gold standard on August 15, 1971. He did this to create jobs and promote exports to help the U.S. economy, also to devalue the dollar for the welfare and warfare state. Because guns and butter and all the military spending during the Cold War, post-World War II, and the Cold War spending, along with all the welfare programs promised, I think, under Lyndon Baines Johnson. Lyndon Baines Johnson promised a lot, but there were other presidents that did it as well, and it was just cumulative for decades of excess. And if you want to actually read something very interesting in financial history, besides the essay that Alan Greenspan wrote when he was a young man, talking about how gold was important and how the people running the government would steal things with currency devaluation, with inflation and taxes. Warren Buffett's dad was a congressman, I believe, from Nebraska, and he was the Ron Paul of his generation. So if you want to go back and read some very interesting quotes, he was one of the few people in Congress, like Ron Paul and Rand Paul and Justin Amash and Thomas Massey, who I really like. One of the few people in Congress back then who actually had a lot of integrity. So Warren Buffett was not a chip off the old block. His dad was a limited government, defend the dollar, low taxes, gold standard type of person. The speeches the father gave are pretty incredible. In the 50s, I believe. Okay, back to the article. So, okay, what actually happened instead? The U.S. had 3 recessions back-to-back in 1974, 1979, 1980. The stock market crashed in 1974. Unemployment skyrocketed. Inflation flew out of control between 1977 and 1981. U.S. inflation in that 5-year period was 50%, and the value of the dollar was cut in half. Again, the lesson of currency wars is that they don't produce the results you expect, which are increased exports and jobs and some growth, but the people in power, the economists, the central bankers, the academic economists, the people in Treasury departments do not learn from history. The main lesson about history is that most people don't learn from history. And history is doomed to repeat itself. Okay, back to the article. Sorry, we'll keep going. I'm going off tangent here. Just adding fun things in here, little tidbits. Again, the lesson of currency wars is that they don't produce the results you expect, which are increased exports and jobs and some growth. What they produce is extreme deflation, extreme inflation, recession, depression, or economic catastrophe. What I would also add in there is stagflation, really bad stagflation too, misallocation of capital. Jim Rickards is not an Austrian school economist. As an Austrian school economist, I would add that they produce stagflating tax and lie. This brings us to Currency War III, which began in 2010. So he jumped over the whole period from 1985 to 2010, that 35-year period. What was going on then? That was the age of King Dollar and strong dollar policy, even though Ronald Reagan was doing massive supply-side economics and massive deficit spending. But I think the politicians had taken the debt to GDP. Both political parties had actually worked on reducing the debt, Republicans and Democrats back then, for decades, to get it back down to 30% debt to GDP by the time Ronald Reagan came in. So Ronald Reagan's actually his views in history are viewed at that he was a low spender, but it's actually, the truth is the exact opposite. He spent big to try to defeat the Soviet Union in the Cold War, and then he did the drug war and all that and some of the other stuff. I believe he almost doubled the debt to GDP ratio. So I think it went from like 30% up to around 50%. Jim Rickards talked about this in his interview with Keith McCulloch from Hedgeye in the last week or so, if you want to listen to that. So really good hour-long discussion. Okay, that was the King Dollar period of strong dollar policy. That's the BS that Larry Kudlow still talks about. I'm not sure if he still talks about it. He used to talk about it every single day as long as he was on TV on CNBC on a show. Talk about King Dollar. Larry Kudlow want to go back to the 80s with cocaine and hookers. It was a period of very good growth, very good price stability, and good economic performance around the world. It was not a gold standard system, nor was it rules-based. The Fed did look at the price of gold as a thermometer to see how they were doing. Basically, what the United States said to the world is, quote, we're not on a gold standard, we're on a dollar standard. So the U.S. agreed to maintain the purchasing power of the dollar, and trading partners can link to the dollar or plan their economies around some peg to the dollar that will give us a stable system, which I disagree with because these currency pegs are the problem. I disagree with that. These euro pegs, these dollar pegs, they're all mess. There's a lot of cheating there. There's a lot of ways to mask rot in a real economy. These currency pegs, I think, will, over the next 5 years or so, a lot of them will blow up. Kyle Bass has talked about the Hong Kong dollar peg may blow up in the near future. Their banking system, I think, has, 900% to debt to GDP in just the Hong Kong banking system, because a lot of Chinese money is parked there. And a lot of bad loans in Chinese real estate, mainland Chinese real estate from Hong Kong banks. Okay, that actually, he's claiming that the dollar pegs and euro pegs worked up until 2010. So they had the illusion of working. Let's just say that. They had the illusion of working. There was a lot of problems, but nothing necessarily blew up. Most people don't recognize inflation if it's not too much, and if they do recognize that something's wrong, they normally just blame capitalism anyway. So when the U.S. tore up the deal and basically declared Currency War 3, he's saying Currency War 3 started in 2010. President Obama did this in the State of the Union address in January 2010. And here we are, and they're still continuing. I would say that these things take breaks, though. I don't know if it started in 2010, but because the central banks were still coordinating with each other then, I think they were still taking turns, but it started around then. Okay, so I'll attach a link to the rest of the article if you want to take a look at it. Unless you have a heart condition. Felix the Cat, nothing wrong with coke and hookers unless you have a heart condition or you have low bank account. Okay, this is a good question. M. Timmy 2013, do I think recent events have completely validated Jim Rickards' currency wars and other theses? I think a lot of Jim Rickards' research is very good. I don't agree with everything he says. He even says this, he's not an Austrian school economist. So I think we're going to disagree on a lot of things about that, about how I look through things through an Austrian school lens, and he does not. He says that von Mises would be a complexity theory person. Maybe von Mises would agree with some of that, I'm not so sure. It's not like we can ask von Mises. He died, I think, decades ago. So I think if you really want to understand things better, you do have to understand that we are starting to accelerate back into worse beggar thy neighbor policies and currency wars. And I think there's a lot of evidence now, and Trump's putting it out on Twitter. There's a lot of tweets lately about this, that the U.S. is restarting, and I think Trump is driving this bus. I'm not sure how much the Fed's on board with this. I'm sure there's some people at the Fed on board. I know the Fed doesn't want a strong dollar. We all know the Fed wants to maintain the illusion of a strong dollar while actually controlled devaluation of the currency. But I'm not sure how much of a currency war the Fed actually wants, because we just had the president of the Boston Fed, I think, in the last couple weeks. He didn't want a rate cut, and then the rate cut came, and he was angry that the rate cut happened. So that just proves my point that there's panic, confusion, chaos, and desperation at the Fed. There is a lot of infighting inside the Fed. They do not, even the head of the Federal Reserve and the governors, the bank presidents, down to the lower level PhD economists, they are arguing really, really badly over what to do. And that's because in the whole scheme of things, they can cut rates, they can slow quantitative tightening, they're trapped. Once Ben Bernanke did what he did, it was on the path to Japanification. And that's where all these central banks are on. China thinks that worst case scenario that China goes to Japanification. China, I can tell you, I've heard from sources that the people in China the worst case scenario they think is Japan. They're 100% confident that the worst case scenario for China is Japan. So I think it is worth reading Currency Wars to understand the mistakes of the past. But you know what? The people in power don't care about history. That's the freaking truth. They don't care. They're going to make a lot of the same mistakes, or very similar mistakes from the 1920s and 30s. And that's why we are where we're. Excuse me. That's why we are where we're. Bleh. Been talking now for 30 minutes. I need some water. Same mistakes in the 1920s and 1930s, and that's why we are where we are now. And the water helped. Malakale 57, wouldn't the real problem with the strong dollar be the emerging market debt issued in dollars? Exactly. Exactly. Plus, the U.S.'s unfunded liabilities would be stronger. If they have a weaker dollar, it would get paid. The payments would be in unfunded liabilities like government employee pension funds and cost of living adjustments to people on welfare and other social programs. It would be in a nominal dollar. So the dollar would look like it's strong, but it's really being devalued. Do you understand? So the purchasing power would be stolen, which is what governments want. I've talked about this a lot over the years, understanding the difference between a nominal return and a real return. And it involves understanding the real inflation rate. So comment if you think that the U.S. is intentionally, it looks like Trump is driving a lot of this more than the Fed. Intentionally, and I've heard also that Mnuchin is pro-China, which is weird. I just heard that today. So comment in the comment section of this live stream show, and also after the video is over, if you think that Trump is intentionally restarting a currency war with the European Union and also with China. Yeah, and there's a lot of emerging market debt issued. So Mullikeel, I've talked about this as well. This is something that you will not hear other experts talk about, where the Fed is watching both dollar indexes. So we could have a situation where the regular dollar index is correcting, and then the trade-weighted dollar index, which is the dollar against emerging markets, is weighted. And the Federal Reserve created the trade-weighted dollar, where that's taking off, where that goes above 130, and the dollar is just getting too strong against emerging market currencies. And remember, I laid out how there's approximately now, according to the Bank of International Settlements, $11.8 trillion outstanding in dollar-denominated debt outside the United States. And that's non-banking financials. So that means banks have dollar-denominated debt too, but the Bank of International Settlements won't list it. I'll have to speak to my hedge fund contacts to see if I can get a number on that. The euro dollar market is also, 16, according to Jeffrey Snyder, the real expert on the euro dollar, 16 trillion? So that's dollar denominated debt too. You know what's funny? I saw this before I started recording. There is an article on currency wars from thebalance.com, and they do some interesting financial writing. And this article claims, I have to read this because it's funny. Okay, let me pull this up. Give me a second. So a currency war is when a country's central bank uses expansionary monetary policy to deliberately lower the value of its national money. The strategy is also called competitive devaluation. In 2010, Brazil's finance minister Guido Mantega coined the phrase currency wars. He was describing the competition between China, Japan, and the United States to have the lowest currency value. His country's currency was suffering from a record high value, hurting its economic growth. And this is why Brazil borrowed a lot in dollar-denominated debt, because they were expecting the dollar to remain weak. And then when the dollar rallied, this is one of the main reasons, besides other corruption, that Brazil got in trouble. Countries engage in currency wars to gain a competitive advantage in international trade. When they devalue their currencies, they make their exports less expensive in foreign markets. Businesses export more, become profitable, and create new jobs. Yet this is mercantilism that they're talking about. They didn't label it as such. As a result, the country benefits from stronger economic growth. Again, this is mercantilism and ignoring the repercussions of more inflation. Currency wars also encourage investment in the nation's assets. I don't know about that. The stock market becomes less expensive to foreign investors. Okay, that's possible. See, if you're devaluing your currency too much, though, then investors don't necessarily want to come in. Or you can have the country that's devaluing, you could have them put capital controls or seize assets. So just because the assets look cheap doesn't mean the government will allow foreigners to own the assets. Foreign direct investment increases as the country's businesses become relatively cheaper. Yeah, but again, these countries have capital controls, a lot of them now. There's not free markets, there's not free trade. You can't immediately in a lot of these other countries do unlimited foreign direct investment. There's an enormous process to go through. And with China, and this is why the real reason for the trade war is China, for a lot of foreign direct investment, you have to go through enormous regulatory hurdles, and you have to get licenses, you have to get a Chinese partner normally. I think close to 50% Chinese partner. And then there's forced technology transfer in addition to the corporate espionage, the intellectual property theft, the theft of research and development, etc. Okay, I'm going to find this. Oh, this is the funniest part of the article. I found it. So it says United States currency war, this part of it. It says, quote, "This is hilarious. The United States doesn't deliberately force its currency, the dollar, to devalue, but its use of expansionary fiscal and monetary policy has the same effect." This article is like so mainstream. I can't believe they wrote that. I have to read that again because it's so funny. The United States doesn't deliberately force its currency, the dollar, to devalue. All these countries are devaluing their dollar. So there's a lack of understanding here, just in this article, about the history of the dollar. The dollar's purchasing power, according to the government's own inflation data, the Federal Reserve's own inflation data, the purchasing power, the value of the dollar, has been devalued since the 1940s or 50s. It's down enormously. It's been devalued enormously. I think since the Federal Reserve was created, it's down more than 90%. That means that they could keep devaluing it as long as other people will hold it. See, that's the thing. If a lot of people don't understand financial history, don't understand what's really happening, they can be tricked into still taking the currency. This is the problem not just with the dollar, but with all fiat currency in general. Most people don't understand what's really happening. One of the few things I'll agree with John Maynard Keynes with is that 1 in a million actually understands inflation. Okay, I'll take listener questions and comments. I'll take a look, and then I'm going to go. I think I covered pretty much everything. Okay, so my definition of inflation according to the Austrian school is an increase in the money supply and credit, which leads to higher prices. So higher prices are a effect or a symptom of inflation. They are not the cause. So inflation is just, the higher prices is just a measurement of inflation. One way to measure inflation. The real inflation is how much money supply growth, how much credit growth, because that's going to mean higher asset prices or higher consumer prices, misallocation of capital and resources, and probably credit bubbles or asset bubbles, and then a credit boom and then a credit bust. Although we've had credit busts that have been delayed a long time lately. But eventually, I think there will be some type of bust or some type of system reset. I'm reading through listener questions and comments here. History cannot be your guide. The Bank of International Settlements made gold a Tier 1 reserve asset on April 1st, 2019. Yeah, but how many private sector banks have actually bought physical gold yet? From what I've heard, a lot of the private sector European banks for the last 10 years have been selling all their gold. And that's where the Swiss gold refiners... There's a great interview on Jim Rickards' podcast. He did it like 4 years ago. He is on the board of directors for the Swiss Physical Gold Fund. which stores a lot of physical gold in Switzerland, and he interviewed the director for a Swiss gold refiner, one of the largest ones in the world. And the guy, I'll try to find the interview for you guys and put it in the information section. I'll try to put it at the end of the video here. And basically what the director said was that he's worked in the industry for the last like 30 or 40 years. I think 30 years. And he started off, at the bottom, working his way up in the company, and that a lot of the gold being recast into 4/9 kilobars and going into China. And he said he's never seen a Chinese 4/9 kilobar leave the country. And my source, my best source in China, has said why? Because it's illegal to remove gold bullion from China. I guess a lot of people don't know that. But he said that all these European private banks and European central banks, and banks in London and Bank of England and stuff, like the LBMA, that's where the majority of the gold was coming from. He said that the majority of gold that the Swiss refiners were getting to melt down and recast into 4/9 kilobars and ship off to China were all from European banks. So just because the Bank of International Settlements made gold a Tier 1 reserve asset doesn't mean that a lot of people own gold yet. A lot of a lot of banks own gold. A lot of banks don't own gold. So now the banks have the option to buy gold in their Tier 1 assets, but a lot of American banks, the actual better incentive there is what Victor Sperandio said with treasuries. It's hold-to-maturity treasury accounts. So they could buy, if you're not familiar with Victor Sperandio's thesis, it's that about, I think, 2014, the large U.S. banks went to the Federal Reserve and got rules changed, and they were allowed to create a hold-to-maturity treasury account. And in those hold-to-maturity treasury accounts, so these banks are primary dealers, they're required to buy U.S. treasuries a certain amount if they can't sell them. And normally what has been happening for the last, I think since the 70s and 80s, is the Federal Reserve has been buying back the bonds in the secondary market from the banks and getting a premium. So the banks stand at the treasury auctions and buy the treasuries if other people won't buy them, and then the Fed buys them back later. But this was not hundreds of billions of dollars initially when it started. It was just billions and then tens of billions. It started off small, and now it's snowballed. And the banks in the hold-to-maturities accounts, now, which after the rules changes in the last 4 years, they have hundreds of billions of dollars in U.S. treasuries in there. And even if they lose any money on the treasuries, they don't have to mark any of their losses off. So they hold it to maturity, and it counts as a positive asset on their book to use for loans and collateral and stuff. And it's counted as a winning investment, a profitable investment for the banks. I just got a super chat, and I'm not sure what currency. What currency is that? Tarquinius. Thank you very much for the super chat. I do not know what currency that is. But thank you very much. So the gold community, again, is KRW. So the gold community has latched onto this, and in the long term, the Tier 1 assets may mean something big. Okay, now we know that these central bankers outside the United States are accumulating a lot of gold. However, these private sector banks, especially banks in Europe and a lot of banks in the US, there is no evidence they're buying a lot of gold yet. They may eventually buy a lot of gold, but right now the incentive structure, the main incentive structure for US banks, large US banks at least, is to buy treasuries because of what Victor Sperandio said. That is my humble opinion. They may eventually buy gold. I have not seen any evidence that there has been large gold purchases by JP Morgan of 100 tons of, the European banks. I have not seen evidence of that yet. As far as I know, the large private sector banks in Europe, what they're doing is they are still net sellers of gold. So anything at the back of the vault, old gold coins, those old gold bars, all those old gold rounds, government sovereigns, sovereign coins, sovereign bars, all those things are being sold to Swiss refiners. They've been liquidated nonstop for the last 10 years. So the Swiss refiners are really the main, I would say they have their fingers on the pulse of the gold market better because they actually see where the demand flows are going and where the supply is coming from. But that's the Chinese government though. I was talking about private sector European banks. So this Bank of International Settlements Tier 1 asset, this is for private sector banks. So these are for like Deutsche Bank and Credit Suisse and the French banks, which are escaping me at this moment because I've been talking for over 40 minutes now, and the large U.S. banks. And I have not seen an announcement yet from a large U.S. bank or large European bank that they're buying 10 tons, 20 tons, 40 tons, 50 tons of physical gold yet. As far as I know from the research I've done, and I've done extensive research on this, and I have a lot of contacts in the gold industry, that the large private sector European banks have been enormous net sellers of physical gold. Yes, SocGen, Credit Agricole, BNP Paribas, yeah. So they've been the ones who have been selling lots of physical gold for a long time. It goes to Swiss refiners, it's recast normally into 4.9 kilobars, and ends up in China, and then it doesn't leave the country because it's illegal to export gold. What proof is there that JP Morgan has silver? I spent about 2 hours a year ago going through their financial statements, looking through all the footnotes of their annual reports, and I didn't see anything in there. So this has been a big theory in the gold and silver community that JP Morgan owns this massive silver hoard. What is it, 300 million ounces or something? And I looked through their financial statements, even in the footnotes. I spent almost 2 hours doing so, and I didn't see any hint of it. Now, if someone has the link, I'm open-minded. I'm willing to take a look at it, but I haven't seen any evidence. It's just a handful of people who keep repeating it in the gold community. I haven't seen any declaration on a page of their financial statement saying we own in a vault in Singapore 100 million ounces of silver there, and then 100 million ounces of silver in this vault. I haven't seen any of that. Okay, guys, well, I'm getting tired here. Ugh, trolls. Okay, guys, well, I'm getting tired here. I'll see you guys later.